On behalf of ICICI Securities, I welcome you all to an exclusive webinar on Energy Markets Outlook. My name is Ramesh Varkhedkar. I head Commodities and Currencies at ICICI Securities Limited. At ICICI Securities, we believe in continuous education and knowledge dissemination to our clients. And we have been doing series of webinars. We did our first webinar in Jan 2022 on energy markets, which was followed by basics on commodity options in June 2022. The links for both these webinars are there in the description for you to refer. We have been doing these webinars, especially on commodities, as they have been growing exponentially. Commodity options volumes have increased 500% over last year. Now, current average daily turnover is 40,000 crore per day on commodity options and another 25,000 crores from commodity futures. So markets have been going humongously. Today, we have Mr. Arpit Chandna with us, who is trading specialist, commodities and energy markets from Refinitiv. Refinitiv, a London Stock Exchange company. Arpit manages most of the major oil companies in India. Arpit, welcome. Request you to share your views on energy markets, which is crude and natural gas. Over to you.
Thank you, Ramesh sir, for having me back again on this series of webinar. It's really a pleasure to share the knowledge that we have been witnessing on the real grounds in the market. I think crude oil market has been really reactive in these period of time, owing to the lot of events which has been happening around the market between Russia and the Ukraine. So a lot of geopolitical concerns have brought in the focus on the energy deprived economies, and the things have been evolving. I think it's really nice to focus and look upon the markets on the aspect of the basic fundamentals. So that's how I'm here again to discuss and share some thoughts on the fundamentals, which would definitely help people to understand how the COVID restrictions are impacting the demand stimulus in China, how the Russian sanctions imposed on Russia in upcoming time, starting from December, would affect the oil markets, as well as we also gonna talk a bit about the interest rate changes which are currently happening across by Fed and ECB, and how the inventory stocks are playing a role in the crude oil prices. If I'll initially talk about the demand and supply majorly coming from China, the China's crude import has fell to an average of 8.72 million barrels per day since June and August, which is the lowest average range for the 3-month period since 2018. So it's a sort of a setback which is witnessed in the Chinese market, owing to their individual fuel demand and the production quotas or the crude quotas which has been assigned to the local refiners. I think the major reason for this fallback in the demand was that renewed COVID-19 curves, owing to this Omicron variant of COVID, has been forcing a lot of Chinese people to stay indoor during their 3-day mid-autumn festival season. I mean, like we all know that China has been battling to contain the highly transmissible COVID variant, imposing lockdowns of various degrees, and people are returning, some of the good lights are the people are trying to return to work from this week itself, showing some negative results from the test which they have taken within 48 hours before. So overall, I feel that is somewhere going to, again bring a positive optimism in the time of these, in this negative era of the timing of COVID. Overall, but still, if we broadly look upon, since I'm saying that the travel has been quite restricted, which is a major driving factor for the energy requirement. The trips of Chinese people by road have been down around 37%, whereas the marine travel is somewhere still less by 15%, and tremendously the air travel has gone down by 60%. So this is as per the reported by the CCTV from China, and all these numbers are in comparison to the last year's changes in these travel patterns. majorly, if we look upon on the supply side of China, Russia exports roughly around 8 million barrels of crude per day, making it the largest oil exporter, like we know. And the Russia has been supplying majorly all these crude during the time of this sanctions, or the rattling of the conflict between the Russia and Ukraine, majorly towards the Asian markets, landing it to a destination of China and India. So in this graph, if you can, if we can clearly see the volumes which are changing, and the total percentage of the volumes which are now flowing to Asia. And obviously, like we know that European Union also relies on Russia for its energy needs. So that's how it would be really dynamic to see in the near future how the things have revolving, and how the Russian crude will secure the marketplace and the market share going up time. Yeah, so since I just gave you a point of view about the market share. So here clearly we can see Saudi Arabia still remains the one of the largest supplier to Asia's top six, Asia's top consumer, China, whereas we can see the gradual pace is picking up in the Russian crude also, which is reaching the Chinese market now. So clearly we can see a difference as in how the volumes are fluctuating among these suppliers. So that's how I believe that Russia is going to look out for the alternative markets which are more friendly and non-sanctionable over their crude. So the another thing, or the next driver for the crude oil market is obviously the US economic indicators. Like we were talking about the Fed interest rate hikes that has been previously happened over a period of time, and ECB also changing its stance over the interest rates. So in the past week, US consumer prices rose by 0.1% in August, giving cover to the US Federal Reserve to deliver another hefty interest rate increase next week for the upcoming meeting, which is due. Although overall inflation has showed some sign of slowing down in the last reported month after continuously surging entirely this year, but inflation is still way above the US Central Bank 2% target. So that's how, I believe that Fed is going to put up a safeguard for the public returns with correction in the interest rate. And obviously, like we know, these interest rate would result in a major strengthening of the greenback dollar, which would obviously make the commodities which are traded in dollars being more expensive for the market. So it's sort of a risk call off that can be there in the market in the near term. But overall, I think that interest rate and the factoring in the dollar index, or the strengthening in the dollar index, could again elevate the prices. Another aspect, if we look upon majorly from the US side, is their inventory levels. As per the latest DOE report, US SPDR oil stocks fell around 8.4 million barrels to 434.1 million barrels, which is being the lowest level since October 1984. And even the Biden administration's plan of releasing 1 million barrels per day from the SPR into the global supply chain is less likely to be extended, although there has been news going across in the markets that it might be extended once it ends in the month of October. But I feel like in the last week we have seen the 50-day moving averages of US and European prices both falling below the 200-day moving averages. So I feel like even releasing certain stocks from SPR would also somewhere are not able to strengthen the market in terms of removing or releasing the tightness on the supply side which is there. But still we can say that the overall oil market structure in US outlook remains one of a tightness which is offset by the cyclic demand and revamping of the production levels, which was expected to be at a higher rate. And since that recovery is happening, obviously the SPR levels are falling down. So the Biden administration might look forward to refill those the SPDRs and the other crude emergency stocks which are there in the country. But that is somewhere, obviously, the factors would be like the prices of crude oil would decide in terms of how much of the crude intake the crude can, the US administration can inject into their markets or their inventory stocks. So, I mean, no, I feel like currently, if we want to summarize the markets, it's like the crude benchmarks, which are currently trading around 89 to 85 to $90, would somewhere can be elevated towards $100 per dollar barrel in the near time, owing to the dollar strengthening and the other factors. And especially, we cannot ignore the fact that the Russia-Ukraine conflict is still, have to reach out a amicable solution. So until that's being resolved, always there would be a volatility in the market to which the prices are always reactive. Also, there has been news recently from OPEC that they are not going to raise their output quotas because they believe the global demand is going to pick up. But so still, I think that might put prices a bit into the pressure, because the demand, like we saw from the one of the largest consumer, China in this case, has been bit nominal, gradual than the past years. So we also expect a bit of the upside to be limited, obviously because of the growing recession fears and rising inflationary prices, across the globe, particularly in Europe, as the winter season is also round the corners, and it would be definitely affecting their budgetary spendings if the gas which used to be easily available from Russia is not now available, and they are looking over for some alternatives. So obviously that's gonna just weigh down over the prices. And also, I think, like we just talked about the US interest rate, which has already risen. It has been raised twice in this year. So Fed is more likely to, come over and persistently look over how the economic data from China as well as from the other countries are going to provide an inflationary outlook about the global economies. But clearly, like we can see, the CPIs are increasing, although some of the economic data from US, like employment and wages, are showing some of a bit strength returning back into the market. But again, a higher earnings would be expected to, have a higher spending, which would overall support the inflation in the near time. So that's how I can, sort of summarize my personal opinion on the markets right now, that the prices environment for the crude oil and the energy sector as a whole would stay broadly bullish, mostly driven by the winter demands. But yes, definitely we cannot, just expect an entire run, and the upside could be limited, owing to the growing recession fears.
Thanks, Arpit, for that wonderful presentation. You covered both the aspects of demand and supply, demand from countries like China, India, supply from US and Russia. Arpit, since our customers also trade in natural gas, I had a question on natural gas. With upcoming winter season, what are the three things that you think that customers should look at, or what are the 3 pointers that one should look at before they trade in natural gas also?
So yes, exactly. I think natural gas has been the most rattled energy commodities out of this conflict of Russia and Ukraine, because the infrastructures like they are placed in European Union, and the connectivity across the major suppliers and the suppliers and the consumers, I would say rather, is something which always European Union has relied on the Russian gas for meeting out their demands. And like, yes, I think the major developments resulted by this Russia-Ukraine conflict has given some couple of new benchmarks to the European market, according to which they are pricing their gas, not relying completely on the Russian benchmarking process or the benchmarking patterns for the gases. So the new benchmarks which has been introduced in European markets are something which one can, follow and see how it is dictating the price terms and how the dynamics are evolving in the price patterns. Secondly, I think it's also important right now to look upon how the flows from US and from the other alternative LNG suppliers gas are reaching out Europe, because obviously on a residential, on a commercial, as well as on the industrial demand patterns, the winter season is going to factor a lot on the residential consumer segment as well. So that's how I think it has to be monitored, that what are the alternative LNG flows that are reaching out Europe. Like majorly it's coming from US and from the other countries. So one has to track down those flows to understand how the scarcity or how the demand would be fulfilled in the winter season. And obviously, like, we have to rely on the forecast of winter season patterns, which are expected to always increase the energy demand from the European Union countries and such countries which are under the snow covers and faces the extreme lower temperatures. So I think, like, if these three factors can be monitored, one would have a better understanding of the natural gas prices in the future.
Yeah, thanks, Arpit, once again for those insights. Now, as our customers have understood the outlook on crude oil and natural gas, I thought I'll just brief upon the product, what is available on crude and natural gas to trade on MCX. We have commodity futures, which are traded on MCX. We have gold mini, gold guinea, gold petal, silver mini. Basically, these constitute two bullion segments. So in bullion, we have 4 variants of gold and 3 variants of silver to trade. Since we are focusing more on crude and natural gas, now crude and natural gas are monthly contracts. The lot size of crude is 100 barrels and lot size of natural gas is 1,250 million British thermal units. Price quotation for crude oil is 1 barrel, whatever the price is quoted for trade, and the tick movement is 1 rupee. And every 1 rupee movement will give you gain or loss of 100 rupees. Similarly, on natural gas, as I said, it's 1,250 million British thermal units, and price quotation is for 1 million British thermal unit, each decrease of 10 paise, and 1 rupee price movement will give you gain or loss of 1,250 rupees. The other futures contracts are these base metals, which is aluminum, copper, lead, nickel, zinc, and in agri, it's cotton. Apart from these contracts, there's also bullion index, which is traded on the exchange. Moving ahead, as I said, on MCX, we have commodity futures and options to trade. One thing which is very important is in commodities, the options are options on commodity futures. The underlying for options is not the underlying commodity, but underlying futures contract. So the option contracts are available on gold 1 kg, gold mini, silver 30 kg, and silver 5 kg. And in base metals, it is copper, zinc, and nickel. As we are discussing on energy products, options are also available on crude oil. Here, each lot is of 100 barrels, and they expire 2 days before the expiry of the futures contract. So I have a calendar which I'll show it to you. So I wanted to highlight saying that options in commodities are options on futures, right? There are two kinds of options. One is options on goods, what we see in equities market, where the underlying is the stock, or an option on goods can also be underlying on a commodity. But here, what we are talking is options on futures, where underlying is a futures contract. And all these all these options contract devolve into futures contract. Like in case you have a long call, right? On expiry of the option contract, they'll convert to long future. In case you are a long put, at expiry, it will convert into short future. In case it's a short call, it gets converted to short future, and short put into long future. So what I want to highlight is the direction will be the same, but all these option contracts will get converted to futures contract. All those contracts which are in the money and which are at the money, all OTM contracts will expire worthless. As I said, option contracts expire with respect to energy, which are cash settled contracts, 2 days before the expiry of futures contract. And again, here also, the quotation is rupees per barrel. All these options are European style options, and there are 15 ITM strikes, which is in the money, and 15 OTM strikes available, and 1 ATM strike. Strike interval is 50 rupees. Let's say crude oil is now trading at 7,000 rupees per barrel. Each strike interval would be 7,050, 7,100, so on and so forth. And the tick size is 0.1 rupee. I talked about how they devolve. Now, this is very important that one has to understand. This is how the settlement happens. Now, here in this calendar, 19th, you can see in red. Let's say 19th is expiry of crude oil futures contract. So 2 days before that, which is 19th and 18th, right? These are the 2 days. So options, commodity options on crude will expire on 15th, which is Friday. तो I think आप सब समझ गए होंगे, अगर अंडरलाइंग कमोडिटी फ्यूचर 19 तारीख को एक्सपायर होता है तो 2 दिन पहले, 2 वर्किंग डे, जो कि 19th और 18th से पहले, क्योंकि 17th and 16th is Saturday and Sunday, which is a holiday, non-trading day, the expiry of option contracts happens on 15th. And as these contracts devolve into future, क्योंकि ये सब जो ऑप्शंस के कॉन्ट्रैक्ट है ये फ्यूचर में कन्वर्ट होते हैं एक्सपायरी के बाद में, 2 days before the expiry of options contract, one starts taking the devolvement margin. So basically 14 तारीख और 15 तारीख को 25% फ्यूचर्स का मार्जिन ब्लॉक होता है, एंड उसके बाद में 15th एक्सपायरी के बाद में इट गेट्स कन्वर्टेड इनटू फ्यूचर्स कॉन्ट्रैक्ट ऑन 18th. So this is what I want to highlight. This is a little different than what it is in the equity markets. So hum at ICICI, what we do is just before the requirement of this margins, which is devolvement margins, all the contracts are squared off around 4:30 p.m. on 13th. Like if 14th is the margin requirement, 1 day before that, 13th, all the contracts are squared off, which is by the system. In case you don't square off, system will square off, so that because most of you are retail investors and you would not like to take a delivery or devolve them into futures contract. This is pretty important. When I speak to customers, बहुत सारे कस्टमर मुझे बोलते हैं कि मैं 20 साल से ऑप्शंस में काम कर रहा हूँ, but let me tell you, this commodity options has started recently and it doesn't work the same way how equity options work, because equity options के अंदर there are options on underlying stock, whereas in commodity options are on futures contract. Moving ahead, at ICICI, the brokerage required is just ₹20 per executed order. You have commodity futures, you have commodity options, and since we are talking about options, the cost of transaction on commodity options is very, very small. Exchange transaction charges is approximately ₹50 per lakh of premium. SEBI transaction charges is ₹10, and on the buy side, the stamp duty for options is ₹300 per crore, or ₹30 per lakh of premium. So what I mean to say is the cost of doing a transaction on commodity options is very, very small compared to commodity futures. And as I said, the volumes are humongous. Today, approximately 40,000 crore of commodity options are traded, out of which 95% of volumes are from crude oil and natural gas. So the whole idea of doing this webinar was to enlighten our customers about what's happening on commodity markets, especially with respect to commodity options, where options volumes have a notional volume are much more than commodity futures volume. And markets are pretty liquid, one can trade, but you just need to understand on this end of settlement, expiry of options, and devolvement of these options into futures. So that's all presentation from my side on commodity options. Whole objective of doing this webinar was to understand the outlook on energy products which are traded on MCX, which is crude and natural gas. Also give a glimpse upon how commodity options are traded, which are a little different from equity options. So I hope this webinar was useful. It was enlightening to you. Only look at this. Commodity options doesn't work as equity options. Please do look at those end of settlement dates, end of settlement time, expiry of these options, and also these options devolvement into commodity futures. So that's all from our side. Thanks, Arpit. Thanks once again for joining this webinar. And it was really, really wonderful to have you with us today. Thank you.
Thank you. It was my pleasure to be here and sharing the knowledge with the traders. I wish traders all the best and happy trading sessions. Thanks.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.